Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments and subscribers. I greatly appreciate it. This week up, we're going to take a look at SBUX. The stock has recently cratered as a result of the entire market meltdown as everyone realizes that the Fed put is no longer. The Fed has converted from monetary easing to monetary restricting, and they are pulling out money of the stock market quickly. Or rather, they're pulling out of the bond market, and as a result, people are pulling out of the stock market to go into the bond market. But that's another video for another time. What's going on is the market is changing. We're getting away from growth. We're going towards value. Let's check a look at SBUX, see how much cash money SBUX makes and how much we can make if we bought the stock today and held it for 10 years. What kind of IRR, what kind of interest rate would we earn on our investment over that time? You ready? Let's get to work. SBUX. Now, before we get into SBUX, I want to remind everyone to read the 10K. You should read the 10K, which is the annual report for every stock that you own. That's going to help limit your stock portfolio to the concentrated few, your best of the best ideas, and force you to do the due diligence every single year and read the 10K that they release. Now, what we're going to do, we're going to review SBUX for the 5 key attributes that we do with all the stocks here at this channel. Number 1, top line revenue growth. Number 2, earnings growth. We use EBITDA, enterprise earnings. Number 3, strong free cash flow. Number 4, low debt. Number 5, it's got to be well priced. A well priced stock to us is a stock with a conservative growth forecast that if we bought it today and held it for 10 years, it would beat the market. Market for us is the S&P 500. That's averaging about 10% any decade period of time. We want to beat 10% on the IRR. All right, let's dive right into SBUX. I've got a lot of work to cover. I built a per unit model for you guys. I want to walk you through how to look at a per unit retail location, and we're going to dive in. It's going to be a little lengthy. It's going to be a lot of fun. Stick with me. Here we go. Okay, let's dive right into SBUX. And what we always do is we begin reviewing the revenue, EBITDA. We're going to go through this, then I've got a per unit model that I'm going to show you. It's going to be a lot more detailed. It's going to be a lot of fun, teach you how to value per unit enterprises. But first, let's cover the basics, revenue, EBITDA, enterprise value. So 2013, $14.9 billion, and that grew to 16, 19, 21, 22, 24, 26, all the way up to $26.5 billion in 2019, and then fell $23.5 billion during the pandemic and rebounded in 2019. Now, important lesson here. You're seeing a lot of comparable period growth as people look in 2021 over 2020, but that growth is largely because of the COVID dip. And you have to make sure that you go pre-COVID and measure businesses. How are they doing pre-COVID relative to current? And kind of skip that year. And so you'd be looking here to here. This growth is a lot less than this growth. Now let's jump to EBITDA. EBITDA follows the same pattern, right? 2.8 billion, 3.8, 4.5, 5s, drops to $3 billion, and then basically doubles to 6.3. You can't obviously take this. You can't obviously take this growth rate and annualize. It doesn't work. You kind of have to skip over this period and look at this growth rate. But what it does tell me is if over the long term, over a 9-year period of time, they've been growing revenue at 9%. They've been growing EBITDA margin at 10.5%, 11%. So their operating margin has been growing. This is growing faster than this. Operating margin is growing faster than revenue. Good job, team. All right, here we go. Let's look at enterprise value. Enterprise value starts with debt. How much debt do they have in the business? Very little, actually. 1.2 billion to 14.6. This growth here is the accounting change where the GAAP accounting required businesses to capitalize their rent leases. And so this step up is not them borrowing a tremendous amount of money. It's basically recognizing the obligation they always had, which was rent. So in all, $14.6 billion, a little excess cash. Market cap, shares outstanding times average price. I use September average because that's their fiscal year end. You can use the full year, you can use whatever you want. I come up with a market average and I get a market cap that went from $30 billion to $129 billion in this decade period of time. That's a big, big move. Added up, less the excess cash, I get enterprise value, which is the true value of the business. Same basic principle, $30 billion to $143 billion. Now, let's look at a couple market multiples really quickly. Debt, let's check this box right off the bat. How's debt doing? Zeros, spikes to 5.2, and reverts back as the business comes back. And this is exactly why we want to make sure we have less than 3 times debt on any business that we buy. Because during the pandemic, when everything goes to hell in a handbasket, and you have to draw on lines of credit, your operating income falls, you can see what happens to a business that had 2 times debt going into the pandemic, and debt suddenly goes into very high debt levels, 5 times EBITDA. If they were to go to the bank and need more debt, they'd be paying mezzanine rates, which is typically 8, 9, 10% now, plus even some equity to get more money. Maybe not Starbucks, but you get the principle is when earnings fall and debt stays the same, this ratio changes dramatically. Fortunately, the business is righted, which is good. They're now 2.3 times debt to EBITDA, which is here by debt to EBITDA, basically the number of operating years they need to pay down their debt. So that's acceptable, less than 3. Enterprise value to EBITDA, this is the payback period, if you will, the number of times earnings I am paying for the business as an enterprise. Think price earnings ratio, right? That's just on a per share basis. This is the same thing roughly, but for the enterprise level. And what's interesting is it actually traded 10 to 8 times. If I go back another year, this is also 8 times in one more year prior. So it trades in the single digit. It can, certainly post the 2008 meltdown, last meltdown, it traded in single digits. Then, as growth resumes and kind of the euphoria of printed money, the Fed, the whole thing, market multiples get way out of whack. 38, well, that's COVID. 20 times for the business, where just 8 years ago was trading at half that value on a market multiple basis, really does show the premium, the euphoria that people had going into the pandemic. And then, of course, everything rebounds and you get the premium again. This premium has collapsed now. So this premium is no longer there as market has come back down. This number is coming back in line with this. Now we got to see how much money we can make by buying the stock. So very interesting lesson here in market multiples, how they cycle over the long term. Like we always do, let's review cash flow. We're going to start with cash flow from operations, the first third of the cash flow statement. Cash flow $2.9 billion to $5.9 billion, growing at 9%. Annually, and that is roughly in line with the 10.6% that we saw on EBITDA. So that means the accounting team is expensing the cash costs properly on the P&L. I like to see that. Good job, guys. Thank you for being there. CAPEX here, this is a pretty sizable number. This is about 35% of this CFO number. Which is totally reasonable for us. It's not like it's 100%. So what this says is, hey, last year I made $5.6 billion of pure hard cash, landed in the bank account. This is real cash, not profit, cash. From running and selling coffee, I made $6 billion. I had to put back into the business $1.5 billion for new stores, redo of existing stores, new coffee presses and machines, new paint, all the stuff, new drive-through, new headsets, all that stuff is CAPEX. That's $1.5 billion. I subtract these two, and I'm getting roughly $4.5 billion of cash. After that, you've got your debt payment. Now, Starbucks has very little debt. You can see that they bought down debt post-pandemic, but I think going forward, I'm not expecting them to have to lower their debt. So I'm not going to use the debt in my go-forward cash flow because their debt is less than 3 times. I'm not going to force them to pay it down in the model. I think they can exist with the amount of leverage that they have on their balance sheet. This borrowing here is basically them financing some of the CAPEX. Right? You build a brand new store, you can go to the bank and say, hey, I want to borrow some cash to go build this new Starbucks location. Bank will happily lend you on that. So that's what this borrowing is. It's helping to finance the CAPEX, which is totally fine. Free cash flow in operation. This is exactly what we're buying. As owners, you want this number. Here's the share count. If I put it on a per share basis, I get $2.42 last year. Prior to the pandemic, it's kind of all over the place because some of the debt payments, it's kind of all over the place. 4, 3, it's probably in the 3 range, I would say, pre-pandemic. If I strip out the debt payment and just look at these two, what are they earning in cash and what do they have to put back in the business? After that, what do I get? It's probably $3 and change. Share price and a yield. Yield averaging 6.5, that's probably a little high, but that's cash flow. So it looks to me like we're kind of checking the boxes here. Is revenue growing, earnings growing, debt is manageable, cash flow strong. You've got a pretty good margin here, cash flow from operations versus CAPEX. If this is roughly 35% of that, That's 65% left over the cash flow that I can then pull out as the investor, and that's what we're trying to buy. So let's value this stream. Now, how are we going to do that? We're going to do it on a per unit model. I'm happy to show you this. Let's check it out. Now, before we dive into the per unit model, I want to remind you that I do teach a finance course at cashflowinvestingpro.com. Check it out. There's a link down below where I teach you how to value stocks on your own. But let's keep going and let's dive through Starbucks. So what I've done here is I've just listed out in history all the stores they have. So 2013, 2003, 7,000 stores have grown to 30,000 stores. I'm going to put this on a graph so it's easier to see because that's just an eye chart otherwise. So here's a chart for you. The blue bars are the number of stores they have. They're approaching 35,000 stores. Probably next fiscal year, they'll probably get it. This line is the growth rate. I got growth off to the side. The 0 bar is basically here. Up is positive. And what you're going to notice is as they scale, as they get larger and larger, the growth is falling, right? So growing 20% before the first crisis, the first housing bubble, they're growing 20% a year. Boom, boom, boom. Amazing. Huge premium for the stock. Everyone's loving the company, right? Economy takes, growth stalls. They basically hold flat as the economy stalls. You're in a recession. You're not adding stores. And then growth picks back up, 8-9%. But look, it's been going down a little bit. And so how are you going to forecast this? I'm going to forecast this basically 3% flat going forward. Because I don't want to go back up. That's an assumption on me. I think as they scale in terms of size, it's going to be harder and harder for them to grow. That's what we always do in this channel. You can start off with a good growth number, but as they grow, as they get bigger, it's going to be harder to grow as a percentage. You're going to bring that percentage down. So when we're looking at per units, this is what we're going to do. We're going to take our this is the number of stores, this is the change in the number of stores, and this is the percentage change. I basically just graphed these two lines. And all I'm going to do is I'm going to say last year they built 1,173 new stores, net new stores. I'm going to peg it at 1,000 stores a year, and I'm going to stretch that out for my 10-year period of time, and I'll say there'll be about 45,000 stores out 10 years from now, and on a percentage basis, that's about 3 to 2% as they get out bigger. Okay, now we have the per units that we're going to use. Now let's figure out what kind of margin they make on each unit. So here we go. You can take the number of stores that they have, divide it by the revenue they produce, because most of their revenue is from the store locations. They have the ice cream in the shops and so forth, but as a percentage of revenue, it's not nearly as big as the stores themselves. So, total revenue divided by 767 stores gives me just over $750,000 of revenue per store. And that revenue has grown over this 9-year period of time to about $860,000. These are in millions, so this is $860,000 per store in revenue that Starbucks generates. And what I'm going to do is I'm going to grow that. I'll show you how to grow that in a second. EBITDA per store, basically 19. And what I did is I looked at a margin here, and I said on a margin basis, it ranges from a high of 24 times. This is margin per store, not at the corporate level. I'm looking at a per store margin. So it's $210,000 per store divided by $850,000 per store gives me a 21% margin, EBITDA margin per store. This is basically 21%, and I'm going to use this 21%. They had 22. I think the unionization is a threat to margin. It's going to cost them more. It's going to slow growth a little bit. So I'm going to use a slightly lower margin. But I still think there's further risk there that it could fall if they had to close more stores, if they can't operate the full time that they need to. I know Starbucks by me closes now at 4 o'clock in the afternoon. So if they can't run them as much as they used to, they're just not going to make as much money. So there's some risk here, but I'll use the 21. In terms of growth, I'm going to grow price per store at 3%. If I look outside of these kind of big numbers here, that's an anomaly. If I look at this and scrap this negative number, I'm averaging a little over 3%. So I'll take 3%. And what this 3% is the growth rate of revenue per store. So if you started at $750,000 per store, $777, $830,000 per store, blah, 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 all the way down, that's roughly 3%. And what I'm going to do is I'm combining a 3% growth in stores, the number of stores, the store count, with the price per, the revenue per store growing at 3%, basically to give me a 6% top line revenue growth rate. Does that make sense? So in a per unit model, anything, Costco, I'm blanking on a whole bunch of retail business, but basically any retail business that's got per unit, you can say number of units and then the same store sales for each unit. I've got 3% growth in the number of units and a 3% per revenue growth with a fixed margin of 21%. What does that produce? Well, here's my revenue. Then I just multiply that. I get my revenue, I get my EBITDA, and my combined EBITDA growth rate, 6%. Now let's keep going. Let's finish the rest of this, then we'll plug in and see how much it's going to make. So here's my EBITDA margin. Cash flow to EBITDA, just looking at a ratio. How much, if I have so much EBITDA, how much free cash flow does it generally generate? Free cash flow is basically 88% of EBITDA historically, so I use that. CAPEX, they put roughly 32% of cash flow from operations back into the business, so average that and peel it off. And now I have a cash flow forecast. This is my cash flow based on the EBITDA that we built, based on the 1,000 units with a 3% per same store sales growth rate. I get $5.7 billion of cash flow from operations, less $1.8 billion of CAPEX. Debt we're not touching, we described that earlier. Gives me free cash flow, divide by the shares outstanding, I have a cash flow forecast. That is how you build a simple per store business model. And you gotta try to break down, and I encourage you, any company you're looking at, break it down to its per unit economics, forecast on the per unit economics. You're gonna have a much better understanding of what the business is doing. Okay, let's go drop these into our forecast model and come up with an estimated price. Okay, here we go. We got our forecast. Before we touch the forecast, I want to remind you guys that in addition to the course, I also have a cash flow club where I produce one-pagers multiple times a month on a whole host of companies that I can't review, I can't make videos for. And in this, you get 10 years of financial information. You get the 5 key factors, you get a forecast, you get a write-up, and it explains how much cash flow the business is making and if we think it's going to beat the market or not. We're throwing those out there. I got some analysts that are helping to make more and more videos. Please join the Cash Flow Club. Check it on the website and the link below. You can download a free report. Okay, EBITDA, we're picking this up just from the last chart that I just showed you. That's basically just pulling it over, and you get a growth rate. 2% year over year for last actual, because I dropped the EBITDA margin from 22 to 21%. That weighs on it. And the growth rate is slightly less, the 1,000 units less than the 1,200 or so that they did the prior year. So I think this year, growth is going to take a little hit, but the existing CEO's coming, or this can be the founders coming back as CEO. So I think he's going to step that up going forward. $6.5 billion to $10.7 billion out long term. This forecast is slightly lower than a previous forecast. It doesn't change the answer germanely. It's just interesting to note. Slight down. 16 times, bring the market multiple down a little bit to 16, gives me $171 billion enterprise value, less a little bit of debt, didn't have any excess cash, $156 billion market cap, divide by 1.1 billion shares, did I say million? 156 billion market cap, divide by shares, gets me a future price of $133.78 out 10 years from now. Okay, let's look at free cash flow. Free cash flow is the same story. $3.31 has grown to $5.44. I'm applying a 4.5% free cash flow yield to that, and I get a long-term price target of $120.91 for Starbucks out 10 years. Okay, now like we always do, now that we have a price estimate, we've got a free cash flow price, $120. You've got a market multiple price, $133. Two different price estimates, two different models. And now we look in the stock market. Now that we have an idea of what we think it's worth long term, let's go look at what we can buy it for. Right now you can buy this stock, all the stock you want, for $70 a share. If we drop this into an economic model, how much is it worth? Well, you've got your stream of free cash flow, $3.33 to $5.44. I can buy all the shares I want at $70. I think I'm going to sell them out a decade from now at $127. This is my IRR, and I get a 12% excuse me, this is my free cash flow, and I get a 12% IRR out 10 years. Now this IRR is an annual rate of return. So that means if I buy a share for $70, I think that $70 is going to earn 12% every single year for a decade. That's what the IRR represents. And this IRR at 12% is beating the S&P 500 for any decade period of time, which is 10%. Let's recap the 5 key attributes. Number 1, top line revenue growth. Yes. Number 2, EBITDA growth. Yes. Number 3, free cash flow. Yes, it's strong and growing. Number 4, low debt. Yes, it's less than 3 times. And number 5, well priced. Yes, Starbucks is well priced at $70 a share because it's currently yielding 12%. It's estimated to earn 12% annual for 10 years with a conservative growth forecast and a reasonable market multiple. We think we can beat the market by owning the stock. As I typically do, I show a distribution range because who knows when you're watching this video, if it's right at the release or could be 6 months from now, this stock price is going to move around. So $70 today, but if it falls or goes higher, based on the existing forecast that I just gave you, what does the IRR turn into? Well, if it's below $70, if it's into the 60s, it's a huge steal in my opinion, and I think you should be buying it. Again, this is my personal blog. I'm not making investment recommendations. But the return gets very attractive. As it goes back up above 80, I'd be holding off on it. But I do like the stock, and I do actually wish the employees who are trying to unionize or do what the fight for more earnings, I wish them the best of luck. Honestly, I do. My recommendation to them, if they were listening, if they were watching, is to ask for stock. I would not ask for a raise if I were a Starbucks employee. If I was trying to unionize, I would push my raise into equity. I would say, hey, Starbucks, I want a more robust equity plan. Why? Because of the market multiple. Let me show you. The market multiple drives the value of all businesses. And the market multiple is based on earnings, right? Well, what did we do here? We said we think out 10 years the business is gonna make $10 billion in EBITDA, and I'm gonna assign a market multiple of 16 times to that. So what I can do is I can either take stock, which I can raise my pay as a Starbucks employee, which lowers this number because I'm paying you out in cash. And me as the employee, I pay income tax on it. Income tax is kind of high. It could be, certainly it depends on the state you're in, it could be up to 50% of your income. Probably not for the Starbucks employees, I get that, but it's still a 30% number. So you get a higher pay. You get taxed 30% of that money, and this number is lower. For every dollar this is less, you cut the value of the business by $16. So $1 out of here, this falls by 16 bucks. What you can do instead is say, hey, I want stock in the business. That stock, A, is not taxed to you when they give it to you. And then 2B, when you sell it, you can determine when you want to sell it. You pay capital gains, not income tax. So what I would suggest, and it pays a dividend. So what I would suggest to the Starbucks employee is to fight for stock in the business, become an owner in the business. Don't hit the operating margin and punish everybody. Become a shareholder and make 12% of your money for the rest of your life. That's my advice, for whatever that's worth. Now, what I do want to do is I want to recommend, again, you visit my website, Cash Flow Investing Pro. If you like this type of analysis, I highly recommend you build a focused stock portfolio. This is the land of the stock picker. This is a great time to be looking at per unit economics and individual stocks. Go to my website, cashflowinvestingpro.com, download the course or sign up for the course. I give you this financial model, the Excel, with the formulas, the whole, everything in it. I teach you how to read 10Ks. I teach you how to pull out revenue, EBITDA, free cash flow, operating expenses, how to convert shares for splits or reverse splits, how to calculate the fully diluted value of the shares. I do all that for you, and I explain how to build a forecast model in here to give you a guess at what the future holds. No one knows, but a guess that you can then base your investment portfolio on and have a better control over where you're going in the future. Highly recommend you check it out. Last pitch, I know. Please check out the Cash Flow Club. I'm putting a lot of stocks in there. We got a lot of people joining the club. It's been fantastic. We're having good conversations on stocks, and I throw about 10 stocks in there a month. Some of them are really good, some are short candidates, some are really good buys, but definitely check that out. Finally, for Starbucks, I want to give it a rating. Let's give it a good. We're going to give Starbucks a good rating because it meets the 5 factors. We think the business is well run. Thank you very much. This is the Starbucks review or update. Please, again, down below, throw a comment. Hit that like button. It really helps the channel out. Subscribe if you haven't already. Appreciate that. And then share the video on social media. It always helps grow the channel. Throw a comment down below. What stocks do you want to see? What did you not like in this forecast? Happy to go through it. Up, we're going to pop a couple other videos that I've reviewed recently. Take a look at the value there. Thank you very much. Don't forget, in the description below, you can get a free cash flow one-pager if you check it out. All right, my name is Cameron Stewart from Rational Investing. Thank you very much. Bye-bye.